Are you torn between investing in real estate or stocks? In this video, we'll do a deep dive into the pros and cons of each investment strategy. So whether you're looking for a steady cash flow or that explosive growth, I will help you decide which path could lead you towards that ultimate financial freedom. Hi everyone, welcome back to my channel Ask Parul. If you're new here, smash that subscribe button and sign up to the insider list to get all the latest updates. So let's get started with this 10-pointer guide to help you compare real estate versus stocks. And before I get started, I would like to point out that this video is only for education purposes. Do your own due diligence and research before taking any investment decision and discuss your own unique circumstances with a qualified chartered accountant. So let's get started. The first parameter that we will look into is the time horizon. So real estate is typically considered as a long-term investment. It's best suited for investors who can afford to lock up their capital for at least 5 to 10 years or maybe even more to maximize the capital growth and rental income. Now, stocks is also generally good and better for long term. The higher you stay invested, the better the returns are, but they offer a lot more flexibility for those with shorter term horizons. So if let's say you have invested your money today, you always have an option of taking it out after let's say a few months or a year. Because of this flexibility, I would be ranking stocks or mutual funds, depending on where you're watching this video from, higher on this particular parameter. So the second parameter that we will look into is the return potential. Now, stocks provide better annualized returns in terms of percentage, but in terms of the actual value, that's where the real estate far exceeds stocks. And that's where the concept of leverage kicks in, which is one of the main advantages of real estate. So the concept of leverage is that you can use borrowed money, typically from a bank, to buy a property. Now, this can significantly increase your return. You can actually borrow up to 80%, 90%, or even 95% of the price of the property. But do keep in mind all the necessary risks before deep diving into this. Back to the concept of leverage, I'll give you a quick example. For instance, if the property price is around 500K, a 20% initial deposit, which is 100K of your savings, let's say you have put in the property, assuming this property appreciates every year by 5%, this 5% is not just on your initial deposit of 100K, but this 5% is on the overall property price, which in this case is 500K. So 5% of 500K is $25,000, which means a 25% return on your initial investment of 100K. And remember that it doesn't include other costs, something that we'll talk about that in the next point. But let's assume if you have invested the same money, which is 100K of your savings in a stock or in a mutual funds, it would have taken a stocks or mutual funds at least 20 to 25% annually to be able to match up to the gains that you would have gained in real estate. And that's because in banks' eyes, a property has a much higher collateral value. You can actually use the same concept of leverage in stocks also, and which is available through something known as margin accounts, but it is far riskier, especially during market downturns. And it's highly unlikely that a bank is going to provide you 80 or 90 or 95% of LVR to go buy stocks. So it's because of this power of leverage and the ability for larger capital appreciation over time, I'm going to rank real estate higher on this particular parameter. The third parameter that we have is the total cost of ownership. This is where I would rate stocks better versus real estate. Stocks typically have much lower transaction cost, and there is no big initial deposit which is required. You can actually get started with as little as, let's say, $100 or 1,000 rupees. The online brokerage fees have also dropped significantly in the recent time, and many brokers are offering zero commission trading stocks. But for real estate, that's not the case. You actually need a big initial deposit, at least 5 to 20%. And thereafter, to maintain the property as well, there are all kinds of costs. For example, property tax, insurance, broker fee, etc. So the problem with real estate is that you need a big chunk to get started. And that's actually one of the biggest disadvantages of real estate. But guess what? I have an amazing solution that will give you the best of both the world. So if you're interested in real estate but don't have big funds available to invest right now, you might want to consider exploring alternative real estate investments. Personally, I have been using Momo, which allows me to invest in REITs, which is real estate investment trusts, stocks, and ETFs. It's a great way to get exposure to real estate and other markets, even if you're not ready to buy the property just yet, with no hassle of dealing with management or tenant issues. I have made a previous video explaining what REITs are, what ETFs are. The link is given here. Plus, the Momo app is really easy to use. I am currently using Momo because it meets three criteria that I'm looking for in a good Aussie online broker. Number one is the chess sponsorship. This basically means that you own the shares you buy directly, providing a nice security feature. The second reason is the low brokerage fees. Momo charges only 3 Aussie dollar per Australian share and 0.99 US dollar per US share, making it one of the cheapest brokerage fee in Australia. What's more, Momo offers powerful financial analysis tools such as real-time quotes, 100 plus charting tools, and visualized financial indicators, all for free. The great thing about Momo is that they are offering new users a sign-up bonus. If you sign up using my link, which is given below, and make a qualified deposit, you will receive up to 10 free stocks and 6.8% per annum cash interest for the first 30 days, which is much higher than any Australian high interest savings account can provide. Additionally, you can also receive a brokerage free card worth $4,000 just by completing your first buy order. So don't miss out on this offer and start with as little as $100. It's global in nature, so whether you sign up from Australia, India, US, you can sign up and receive these amazing benefits. So the fourth parameter that we have is around taxation. So I would be ranking both stocks and real estate similar in terms of taxation, and that's basically the assumption that if you have held either of these asset classes for more than 1 year, then it would typically classify as a long-term capital gain. In case if you have invested in an equity, I'm not talking about debt, but if you have invested in equity, mutual funds or shares, or even if you have holded a real estate for more than 1 year, it typically qualifies as a long-term capital gain where the taxation is quite similar. In some countries, you can actually get some tax benefits. For example, in Australia, if you are buying an investment property, you do get some benefits. But for simplicity's sake, I am going to be ranking both real estate and stocks as similar. But do keep in mind that there have been some recent budget changes in India, which has made the taxation on real estate slightly different to what it was previously. I'm linking that video, go check that out. The fifth key input is around understanding of market knowledge. Now, in this parameter as well, I'm going to be ranking both real estate and stocks as quite similar. You do actually need some level of an understanding to get started. It's not actually advisable that you just get started without the basic know-how. In this parameter, I'm going to be ranking them as same. The sixth key parameter is liquidity. In terms of liquidity, stocks are actually slightly better than real estate, meaning that it can be sold quickly and easily. So today, let's assume if you decide to liquidate, you need your funds, the market has been doing well, you can actually go by the end of the day and just, liquidate your assets. It's not the same case as in real estate because real estate is largely an illiquid asset because it's going to take some time for you to find a buyer, then complete the settlement process. So at least a few months it will take to liquidate the asset. And hence I'm going to be ranking stocks as better when it comes to liquidity. The seventh parameter is around price realization. Here again, I'm going to be ranking stocks because stocks prices at the end of the day is a lot more predictable. At the end of each day, you would know the value of your funds. You will know the exact selling price in case if you decide to sell, and you would know what to expect. In real estate, however, you will have an approximate idea of the market value of your property, but it all totally depends on the market sentiments, the seller capacity, and various other factors. So the price realization can actually vary slightly, and hence I'm going to be ranking stocks as better when it comes to price realization. The eighth key parameter is passive income stream. Now, this is where real estate beats stocks because real estate offers more reliable passive income in terms of rental. It's also a tangible asset that you can touch and feel as compared to mutual fund or stocks. And income from rental properties or commercial real estate can actually provide more steady monthly rental versus stocks. In stocks also you have a concept of dividends, but it's a lot less reliable when it comes to the rental that you get from real estate because the dividends is largely dependent on companies' performance. So in terms of this particular parameter, I'm going to be rating real estate higher as compared to stocks. The ninth parameter that we have is volatility. Now, stocks are a lot more volatile when compared to real estate. Real estate is less fluctuating. Yes, there are some seasons and economic cycles. Like, for example, right now we are going through that economic cycle, but overall, in the long run, it's a lot more stable as compared to stocks, and it's much more inflation proof in the long run. So real estate wins here for being less volatile when compared to stocks. The 10th key parameter that we have is divisibility and diversity. Now, stocks is ranking much better here because let's assume you have 100 stocks. And if you only want to sell 10 of them or 20 of them, you do have that option. But that option of divisibility is restricted in real estate. You can't actually go and just sell one bathroom or one kitchen. You have to sell it as an entire property. And similarly, the concept of diversity is much better in stocks because let's assume if you buy an ETF, you can actually buy a portfolio of diverse industries versus being just concentrated to a specific industry. So in terms of this parameter of divisibility and diversity, I'm going to be ranking stocks as much better as compared to real estate. So those were the 10 pointers. Now the big question is, which one is better for you? Well, there is no straightforward answer for that. I feel that both are the must-have assets for everyone. Of course, it totally depends on your own unique circumstances. And this video is only for education purposes. But my personal opinion is that diversification is the key for generating long-term wealth. One should not put all their eggs in one basket. Another good way to think about it, let's say if you're still young, or let's say if you don't have that big chunk of initial deposit, which real estate demands, a good way to look at it is to maybe start investing small amount in mutual funds, depending on your capacity. You can also leverage the SIP route, which is a systematic investment plan. And for the long run, let your money grow in the long run for at least 5 to 10 years because mutual fund can actually be a very good asset for generating long-term growth. And once you have built that corpus through your initial investments in mutual funds, you may not actually need that borrowing from a bank, or at least you would have that deposit coming from your stock portfolio appreciation. And some people might argue here the fear of missing out. They might say that, oh, the property prices will be much higher. Let's say if I'm looking at 5 years or 10 years down the line, which is something I agree. But your investment in stocks or mutual funds would also grow in that same rate and would be good enough to compensate for that. So that's one way that you can think about it. And the other way, which I also spoke about previously, is around the REITs. So let's assume if you don't have that initial investment, you can still leverage the benefits of real estate investment appreciation while using the investment route in stocks through REITs. Do check that out. So now that you have an understanding of how to pick between stocks and real estate, if you have come to a conclusion that stocks are better for you, then you must check out my investment playlist for a deeper understanding and to avoid potential risks. And if you are interested, then do check out the Momo app as well. But in case if you have picked up real estate, which means that you are either interested or are into property investing, then do keep an eye on my upcoming video on buying versus renting. A lot of people actually make those costly mistakes. And for that, you need to sign up to my insiders list and also hit the subscribe button to get notification on my channel. Until I see you the next time, goodbye.